Good morning, ladies and gentlemen. My name is Philip Hurst. On behalf of Cathay Bank, I want to welcome you to our Cathay Bank virtual seminar, Financial Market Performance and Investment Strategies for 2023. In today's fast-paced financial world, keeping up with the latest trends in the market can be daunting. It's also necessary. That's why we're excited to bring you this virtual seminar and share insights about the financial markets today. As a bank that's committed to providing our clients with the best financial solutions and the best outcomes, we believe it's essential to try to stay up to date with the latest market trends and investment strategies. Today, we've invited a distinguished guest speaker, Gene Goldman, Chief Investment Officer and Director of Research from Cathay Financial Group. Mr. Goldman has over 29 years of experience in investment strategy development and money manager research. He's responsible for the direction and growth of research offerings at Cathay Investment Management, and his leads the investment committee. Meanwhile, Mr. Goldman is frequently cited in a range of national media outlets, including the Wall Street Journal, Bloomberg News, New York Times, Reuters, and Forbes. And he's a regular guest on high-profile news networks, including CNBC and Fox Business News. He's been a featured keynote speaker in dozens of industry events. And because of Mr. Goldman's extensive experience in the financial industry and his deep understanding of the markets, we're confident today's seminar will provide valuable insights for all of us. During this event, we're going to cover a range of topics, including factors that will affect bond prices, stock prices, interest rates, and we'll also get forecasts for the remainder of this year into next year. So at the end of the event, we are hoping that you'll have a better understanding of the financial landscape and feel more confident in your investment decisions. Without further ado, I'd like to turn the call over to Mr. Goldman. Gene?
Welcome, and thank you for the introduction. And, just as a side note, I've been with Cathay now. It's been about 12 years, 13 years. It's been a long time. I live here in California. I live in Santa Monica. Moved here in the summer of 2011 from Boston. So occasionally my Boston accent comes out. So I do apologize in advance. As Phil said, I have about 29 years of investment experience. So we have about maybe 30 minutes of prepared remarks. We'll save some time for Q&A, of course. But what I want to talk about is our market perspectives. And what I'm calling it today is all about the Fed. And really the Federal Reserve, is driving our market expectations on a go-forward basis. If you kind of take a step back, for 2023, for this entire year, we laid out the following themes. We said, number one, the Fed stays aggressive, and the Fed has been aggressive, and I'll talk about what that means in a second. Number two, the bad news is that a policy error is likely. A policy error is just this fancy term that means a recession, and we do think a recession is coming. But not to spill the beans, we do think a recession, if we have one, we probably will have one, especially the data that we saw today. If we have a recession, it's going to be pretty mild, and we are pretty confident about that. Sorry, excuse me. And the third thing is that expect a lot of market volatility. The markets are trying to figure out direction right now. They're trying to figure out where to go, up, down. They're reading all the tea leaves. They're reading all the clues. But again, the Fed stays aggressive, a potential, probably most likely a recession, and then market volatility is here throughout the year. So if we take all this together, what is our core expectation? What is our expectation in terms of how do we expect the markets to react? And if you look at what we've been saying, it's sort of like a tale of two cities. The first part of the year, we do believe there'll be a lot of uncertainty. Uncertainty because the Fed remains aggressive. They push us towards a recession. Number two is that valuations are pretty high. Market valuations are pretty elevated right now. And number three is that earnings are a little too high. If you think about investing 101, earnings drive stock prices. So if a company generates more earnings, investors are attracted to the shares of those companies. Earnings are so important. We do think earnings are a little bit too high right now. So three concerns: aggressive Fed, high valuations,
200 or 300 books or 500 books.
And earnings a little too high. Second half of the year is the good news. And the good news is that we really anticipate lowered expectations will be easier to beat. In the first part of the year, lots of market pessimism, lots of concern around earnings and valuations. Pessimism creates lowered expectations. Lowered expectations become easier to beat. Also, we do think the Fed will get the inflation story right. We'll talk about that a little bit later. And third of all, as I said at the onset, if we have a recession, we do think it's going to be a pretty mild recession. So let me talk about the bad news first. And actually, let me take a step back. Before I do that, if you think about my team's tone, we're a little cautious for the first part of the year. But if you think about that, the stock market had a very good first quarter. If you think about the stock market was up about 7.5%, and the stock market is as measured by the S&P 500, and it was a good return. And if you think about that return, though, it was not as strong as it seems. So if you look at this slide, and this slide shows a bunch of ziggy-zaggy lines, but that purple line is the S&P 500, and that's a big, broad benchmark for the U.S. stock market. And what you see is that for a long time, the stock market has been in this range-bound trading area between 4,200 at the top and 3,800 at the bottom. So basically, even though the market did well in the first quarter, up 7.5%, which is a great number, it's been very range bound for a long time, basically just staying in this tight range. The reason for this is that the markets are trying to figure out, where are we headed? Where is the economy going? Where is the Fed going? If you kind of dive in more deeply into the stock market performance, if you look at this slide, the S&P 500, as I mentioned, was up 7.5%, great number. But that return was only driven by pretty much 10 stocks. 10 stocks drove 87% of the return. Here are the stocks that drove it, but basically only 10 out of the 500 stocks drove 87% of the return. What does that mean? It's a very narrowly focused market where not everything was moving higher, only a very small amount of stocks, not a sign of a very healthy market. So the other thing about the first quarter, and I know my first couple slides were all ziggy-zaggy. This one is a super ziggy-zaggy slide, but this one is extremely important. What this slide shows, it shows two data points. The light blue line is the S&P 500, again, that stock market index that represents the US stock market. The purple line is a 2-year Treasury yield. And what you see is that these arrows, red arrow shows the S&P 500 moving up, moving down, moving up, moving down. The purple line shows the 2-year Treasury yield moving down, up, and then up. Why am I showing the 2-year Treasury yield? Who cares about that? Well, the 2-year Treasury yield, and this is so important, it's a great proxy of what the market expects the Fed funds rate to be 1 year from now. So that's a lot what I said. So let me take a step back. If you think about the Fed is the Federal Reserve, as we all know, and the Federal Reserve has a dual mandate. And the dual mandate is two things. Number one, they want to make sure that we all have jobs. They want to maximize employment. Number two is that they want to make sure inflation is in check. And they use monetary policy to basically do all this. If the economy is going too slow, that means we aren't all having jobs. So the Fed primarily lowers what's called the Fed funds rate. They lower this down. When they lower the Fed funds rate down, this theoretically stimulates the economy because borrowing costs go down, auto loan rates, mortgage rates come down, and this theoretically increases economic activity, which increases more jobs. If, on the other hand, the economy is going too fast, then this creates potential inflation pressure because there's more demand for less supply. So the Fed says, you know what? Let's raise the Fed funds rate. Let's raise that Fed funds rate. And then this will increase borrowing costs, this increase lending costs. This basically slows down the economic growth, which reduces inflation. And as we know, I'll talk about this in a second, but the Fed has been very aggressive to raise the Fed funds rate, to raise interest rates in order to slow inflation. So back to this slide. To S&P 500, 2-year Treasury yield. Again, every time the 2-year Treasury yield goes down, that purple bar, the purple arrow, the S&P 500 goes higher. Every time the 2-year Treasury yield goes higher, that purple arrow, the S&P goes down. So again, why is the 2-year so important? The 2-year Treasury yield is an amazing proxy of what the markets are saying that Fed funds rate will be 1 year from now. So when we got good news about inflation coming a little bit lower, the 2-year Treasury yield came down, the stock market rallied. When all of a sudden we got strong economic growth data, the 2-year Treasury yield went higher because the market is saying, hey, the Fed needs to raise rates. So the S&P 500 went down. Again, this is important, but this is what really drove the market in the first quarter. I usually don't spend that much time on what happened in markets because I want to talk about forward expectations, but this is important. The market is so much reacting towards interest rates and especially the 2-year. And again, one more time, the 2-year Treasury yield is a proxy of where that Fed funds rate, that big lever the Fed uses 1 year from now. Okay, we'll come back to that. So let's talk about the Fed. As I mentioned, the Fed has a dual mandate: make sure we all have jobs and to minimize inflation. because inflation has been so high, the Fed has been aggressively raising the Fed funds rate. Remember that lever the Fed uses. And if you look at this slide shows the last 4 rate hike cycles. And a rate hike cycle is when the Fed is raising rates over a long time period. And if you look at the first arrow on the right, or the second arrow on the right, what this shows is that the Fed has raised rates aggressively from 0 or near 0, but we'll just say 0 to 4 3/4 to 5%. And you say a range because there's a lower end and an upper end. So they say basically 4 3/4 to 5%. So basically 4 7/8. But let's just say 4 7/8. So the Fed has raised rates from 0 to 4 7/8 in 13 months. That is huge. That's fast. Let me put this in perspective. If you go to the little red arrow to the left, that little middle red arrow, the last time the Fed was in a rate hike cycle, the Fed went from 0 to 2.5% in 3 years. So again, from 2016 to 2019, they went from 0 to 2.5%. The cycle that we're in now, last year, they went from 0 to 2.5% in 6 months. So last time 3 years, this time 6 months. This shows how aggressive the Fed is right now to stamp out inflation, how aggressive they're raising rates. And as I mentioned before, they raise rates, borrowing costs get higher, mortgage rates have gone up dramatically, as you know, auto loan rates. So all this has ramifications, which theoretically slows the economy down. The Fed is not done. So if you look at, there's a document that the Fed produces once a quarter. It's called the Fed dot plot. And what this is, it's a document that takes all the Fed's voting, all the Fed members, and these are the people that vote for the, whether to raise or lower the Fed funds rate. It takes all their expectations anonymously and indicates where they expect interest rates to be, the economy to be, inflation to be over the next couple of years and for the long term. And if you kind of look at this right now, the Fed is saying, that's what they're saying themselves, that we are going to keep raising rates from that 4 7/8 to 5 1/8. And it's going to end at 5 1/8 at the end of this year. So let me say it one more time. The Fed in their own documentation is saying, we are going to raise rates by 1/4%, and we're going to keep it at 5 1/8 for the rest of this year. So that's pretty high rates. The market, though, is saying, Fed, we don't believe you. We're not sure what you're doing in Washington. We have no idea what you're thinking at your central banks. We don't think you will. What this slide shows, this takes all the market data out there and says, okay, where do we think the Fed funds rate will be at the end of this year? And remember, the Fed funds rate, the Fed dot plot said 5 1/8. The market, based on this document, this analysis, says, Fed, we think you're going to raise rates maybe one more time, and then you're going to cut rates by 0.6%, by 60 basis points. So the market is saying, Fed, we don't believe you. We don't believe you. You're saying you're going to raise rates more. We don't believe you. We think you're going to raise rates maybe one more time and then cut rates dramatically. Question is, why is there a disconnect between the Fed and the market? Isn't the Fed coming out every meeting and saying, hey, this is what we're going to do. We're doing this. We're raising rates. Well, the markets don't believe the Fed for 2 reasons. Number one, the data is slowing pretty fast. So you can look at credit card usage, savings rates, all this data that you can look at. The economy is slowing pretty quickly. One data point, and I'm pretty sure we talked about this before, it's called PMI. PMI is Purchasing Managers Index. It's a survey of hundreds of purchasing managers at the and these are the frontline people. These are the people on the front line of businesses. They're the ones taking orders, seeing business. And what happens is that this company, ISM, takes all this PMI data, compiles it together, and basically says if it's above 50, it's expansionary. Below 50 is contractionary. And this index has it's amazing for 2 reasons. Number one, it's the first look at the last month's economy. And second of all, it has high correlation to market returns. The markets follow this indices pretty carefully. A subcomponent within these indices called PMI new orders. And again, these are the first look at basically March's economy. First look at March's economy. And you see the new orders have tumbled dramatically, both on the services side and the manufacturing side. All the data you look at, and there's some examples I'll show you a little bit later. All the data you look at is saying that the economy is slowing down pretty fast. I know the naysayers are going to say, well, the first quarter was pretty good. First quarter data was really good. But what we saw was that in January and February, we saw some really strong economic data. And part of that was because the weather was warm. People didn't spend as much money on heating. They spent more money. And you saw economic data in January and February really strong. March's data, especially tied to the bank issues, have come down, have pushed economic data down pretty fast, pretty quickly. So a lot of data is slowing down. One thing that our advisors have access to, and hopefully they share it with you, is the chart book. And the chart book takes all that economic data out there and it just summarizes it. And you see on the lower left-hand side, we have what's called a recession riskometer. And the recession riskometer basically says all the data suggesting we are headed towards a recession. On the right-hand side, well, the other little speedometer thing shows that the data trend is negative. All this says that the data is slowing down pretty fast. It is screaming that a recession is coming. No big surprise. You're seeing a slowdown already. But again, not to spoil my good news later. If we have recession, we think it's going to be pretty mild. But we'll come back to that in a second. So, question we get from a lot of you is, a lot of clients and advisors is, hey, maybe we have a recession, but when will this recession take place? And for us, there's two clues. The first clue is simple. And simply it says, on average, it takes about 12 to 15 months for a rate hike to be felt by the economy. So the Fed started raising rates in March of last year. You pull the calendar forward, you're looking at maybe the second or third quarter of this year. And I know January's data was pretty strong, and so was February. So maybe the third quarter of this year. We're seeing some data suggesting between second and the third quarter. But basically, if you think about this, 12 to 15 months after the first rate hike, the economy feels higher interest rates. So you're looking at maybe second or third quarter of this year. The other data point that we look at, and this is more scientific, is this. It's called the leading economic index. And just so we know what this is, it's 10 real-time high-frequency indicators like average hours manufacturing, jobless claims, new orders, building permits, consumer expectations, and they're squeezed together. And what happens, and why is this so important, is that it has a rock-solid track record of predicting when a recession takes place. On average, this index peaks about 13.7 months in advance of a recession. So, and this data, I apologize, we actually have a newer version of this data that came out this morning. The data is even better. So if you take all this data and you roll it forward, basically 13.7 months from when this LEI started to peak, or peaked back in February of last year, you're looking at maybe the second or third quarter of this year. So again, if we have recession, when is a recession? Second or third quarter of this year is our best guess. The second reason why the Fed doesn't believe the markets. No, let me say this back. Sorry, excuse me. The second reason why the markets don't believe the Fed is that the feeling out there is the Fed finally broke something. So if you think about, there's an old adage out there, and it's important. And the adage is, bull markets don't die of old age, but rather they're killed off by the Fed. And it's true. Basically, what this means is that a stock market rally doesn't just all of a sudden die with old age. The Fed comes in and makes a mistake and causes the stock market to fall. This is a common occurrence. If you think about the last 15 rate hike cycles, so remember those little lumps I showed you before, the last 15 times, the Fed has pushed us into a recession 11 of the last 15 times. The Fed makes a lot of mistakes. They raise too much, or they're too slow to cut rates. Again, Fed makes mistakes. So the second reason why the markets don't believe the Fed is that the markets believe the Fed finally broke something. And the key example is just the banking crisis that happened back in March. So as a reminder, if you think about the Fed is raising rates, they're raising rates, it has ramifications. Two reasons. Number one, a lot of banks are hedging their loans with treasuries, or they're investing in long-term treasuries. And not to get into sort of bond investing 101, but when yields go higher, when interest rates go higher, prices come down. And what happened is that a lot of these treasuries held on bank balance sheets fell in value. And some of the banks that got in trouble, what they were doing, instead of investing in short-term treasuries, with less interest rate risk, less of that when yields go higher, prices fall. But if you invest in a shorter term treasury, yields go up, treasuries fall a little bit. Not like what they were investing in, yields go higher, treasuries fall dramatically. And again, what they were doing, they weren't taking credit risk. They weren't investing in bad things. They were just taking interest rate risk. And those are what those banks were doing. So treasuries held at banks fell in value. When they fell in value, basically there was concerns that because they have less value, less money access on their balance sheet, they couldn't meet deposits. So I'm not going to spend too much time on that, but basically issues around treasury prices falling dramatically. The other issue is that you see right here in red, the red circle, deposits at banks have fallen. because basically savers have come out and said, you know what, I can invest in higher yielding investments like money market funds. So you see that purple bar, money market fund investments have gone up dramatically, but then rolling over that light blue line is that deposits at banks have come down. So because the Fed has raised rates aggressively, and people have mobile banking, people are using their cell phones, they're moving money pretty quickly from savings accounts into money market funds. Money market funds, as you know, are a little bit more risky than savings. So basically investors were chasing yield. So this is what happens. Number one, the reception of the Fed has pushed us into a recession. And number two is the fact that the Fed broke something finally. The good news is that the Fed came out, the government came out and created a term of what's called a bank term funding program, which basically said banks can borrow from us at the discount window. I'm not going to get into the mechanics of that, but at the discount window, and as collateral, you use the par value of treasuries. So instead of saying, when you buy a treasury, I feel like I'm getting into this in weeds, so I apologize. So basically, you can use collateral, you can use the par value of a treasury bond, because again, treasury bonds are completely safe. I mean, they're backed by the US government. And what you saw was a significant amount of borrowing from the new Fed bank term funding program, and you also saw a huge borrowing in the discount window. And you can see these lines on the right-hand side. This is from our friends over at Yardeni Associates. The lines have moved dramatically. This is a little dated because this is rolled over pretty quickly. Basically, the stress in the banking system has come down pretty fast, pretty quickly. So again, long story short, is that the Fed probably broke something. And second of all, is that the data is suggesting a recession is coming. I think what you have to think about that last point, the first point about the Fed breaking something, the Fed came in and they provided liquidity to the banks. And that's good news. But there are ramifications. You think about those banks that went under. Because of that, what happened, basically, you expect regulators are going to start knocking on the doors of other banks to review what they've been investing in treasuries, to review everything about the bank. And what you're seeing is that banks are starting to rein in their lending standards. You look at this slide, and I have the red arrow. This is basically lending standards for different types of loans, mortgages, for car loans, for commercial loans, for industrial loans. And you see that arrow on the right-hand side. The lending standards have dramatically increased. Basically, what this says is that you're seeing banks are starting to come out and say, we are going to start to tighten up lending because regulators have come down. We want to make sure our balance sheets are much stronger. So it's becoming harder to get a loan. On the other hand, because you're basically seeing the supply of loans falling via tighter lending standards, the economy is also slowing down. And what you see here is that loan demand is starting to fall too. So basically, companies are saying, we're not going to borrow as much money because the economy is slowing down. So you take all this together, you've got the number of loans that are available are starting to decline because of tighter standards. Then you have the demand for loans are starting to decline too. The concern about all of this, and this is what leads us to a potential recession, is that loan demand and loan supply are falling. This creates a potential credit crunch where companies can't get access to money to borrow, which if you roll through the scenario leads to an economic slowdown and to a potential recession. I know I kind of went into this economics theory right here, but this is what's concerning the markets right now. This is why this week and last week, investors are so focused on bank earnings right now, because they're trying to understand how far have deposits come down. And they've also tried to understand what have banks increased savings rates in order to lock in more savers. So one related issue that you'll hear a lot about, it's kind of a big wild card, and it could worsen the overall economic situation, is commercial real estate. And commercial real estate overall is facing negative trends. Think about, you look at this slide. This slide shows there's been a huge surge in vacancy rates. And this makes sense because of COVID. People have rejiggered their office environment. For example, for me, my team and I, we come, instead of coming in the office 5 days a week, I'm in the office 2 days a week. They're really rejiggering sort of office space. This is creating a huge surge in vacancy rates. But beyond that, if you look at the slide, again, from our friends at Yardeni, you're also seeing tighter lending standards. And if you think about commercial real estate, they need to refinance. And if you think about half of the mortgage, the commercial real estate mortgage debt, it's about 2.9 trillion. And based on some estimates, they need to refinance half of that mortgage debt, half of that 2.9 trillion within the next 2 years. But now if you're a commercial real estate, say a company, you need to refinance borrowing at newer rates at an additional 4% higher on average. So basically, you have to go in and you're facing tighter lending standards, harder to get loans, and when you do get a loan, you're borrowing at a much higher rate. All we are worried about, you take all this together, this really reduces bank profitability, and this could further slow down lending. Because again, if a bank starts to make less profit, then they say, well, we probably won't lend out as much because we're trying to keep our resources intact. So again, I'm going into a lot of different tangents, but it's so important because all these together could potentially create a potential recession. So let's kind of take a step back. If you think about the Fed, again, the Fed has a dual mandate. They want to make sure that everyone has a job, and they also want to make sure that inflation is in check. And usually when the Fed starts to smell a potential recession, and the Fed is smelling a recession, the Fed's own people, the Fed's own analysts came out and said, we expect a mild recession this year. The Fed has come out and said that. But whenever the Fed starts to sniff a recession, what do? They start to cut interest rates. Because remember my whole scenario, my example at the beginning, the economy is going too slow. They start to cut rates because they want to basically stimulate the economy so people have more jobs. The problem is that inflation is still too high. If you look at this chart shows inflation for different major countries in the United States. Inflation is globally still too high. We got UK inflation yesterday. UK inflation came in at what? 10.1% year over year. February was at 10.4% year over year. Inflation is still dramatically higher. Here in the US, inflation is well above the Fed's target, 2%. So even if the economy slows and we're headed towards a recession, we're not sure if the Fed can even cut rates if inflation is so stubborn. So that's one thing that the Fed has not had to face before in past economic cycles. A slowing economy, but at the same time, inflation is now a constraint to the Fed. And then just as a reminder, why is inflation so high right now? Here, this slide, I think the slide lays it out perfectly. Purple line is goods inflation. The light blue line is services inflation. Goods inflation has come down dramatically because we've all stopped buying 10 Peloton bikes. We all stopped buying all these unnecessary goods that we just bought. And basically, retailers had so much inventory, they're cutting prices and so on. Long story short, the light blue line is a different story. That's services inflation. That's people going to restaurants and bars. And that continues to move higher and higher and higher. This is what the Fed's worried about. The services inflation is extremely stubborn. And they're also watching this services inflation when you take out asking rent. I'll come back over that. Let me come back to that in a second. So I went on a long sort of tangent and soapbox on why we think the markets are going to be a little bit concerning and weak in the first part of the year. Basically, the Fed pushes us into a recession. It's going to be very difficult for the Fed to cut rates because there's so much inflation. The second reason we're concerned about the markets is that valuations are so high. If you look at the slide, lots of ziggy-zaggy lines. The purple line is a key point. The purple line shows the price earnings ratio of the stock market. So the price earnings ratio is basically a valuation metric. The higher it is, the more expensive stocks are. The lower it is, just cheaper stocks are. PE ratio today is 18.4 on forward earnings. 18.4. Is that good? Is that bad? Well, the good news is that it's lower than it was a year ago. A year ago it was at 22. The bad news is that it's still pretty high. It's still well above average. And the worst news is that it's pricing in much lower interest rates and much lower inflation. Just as an example, you see those red circles. The red circles show the last time the PE ratio was in this level, this 18.4. Interest rates and therefore inflation were much lower than they are today. The market is pricing in lower inflation and lower interest rates, and we don't have that right now. That's a concern. Earnings. Okay, let's take a step back. The concerns we have: potential recession, high valuations, and then earnings. Earnings have been revised down. And remember, I said this at the beginning. Earnings drive stock prices. If earnings go higher, investors buy the shares of those companies. There's assumptions, but basically earnings drive stock prices. Earnings have been revised downward for 2023. So if you looked at this company called FactSet, and FactSet takes all this analyst data and compiles estimates. September of last year, they said this year earnings are going to rise 10.3%. Now they're saying earnings are going to rise basically up 1%, very flat. We do think earnings are going to actually decline even further or weaken even further because you basically have a slowdown in bank lending, which tightens financial conditions. This could weaken GDP, could weaken employment. If you think about it's going to affect small and medium-sized companies, profits are going to be squeezed. So we do believe, still high labor costs, still high commodity costs, and sales and top line growth are slowing down pretty quickly. All of this is pressuring profit margins. Our expectation, our scenario that we lay out in terms of 2023 is almost like what happened in 2001. So if you think about in 2001, what we had in 2000 and 1999, we had Y2K, we had the tech bubble. Analysts came in and they started raising estimates for all these companies significantly. They're saying, well, everyone's going to be worried about Y2K. Everyone's going to be going to pets.com and buying stuff and clicking and whatever the stories were back then. And earnings were raised dramatically higher. Then we have a mild 2001 recession, very mild, like we envisioned this year. And then what happened is that analysts came in and they cut estimates to pre-Y2K, pre-tech bubble levels. We see a very similar situation right now. The last couple of years, work from home. Analysts raised estimates dramatically. We have a mild recession this year. And again, I'll talk about later why it's mild. And then analysts are going to come in and cut estimates to work from home levels, like back to like 2019 levels. This means earnings could decline another 4 or 5, 6%. I've seen some estimates out there saying 10 or 12%. It's all over the place. Right now, we're watching this carefully. But again, we do believe there's going to be more earnings pressure, which will pressure stocks on a go-forward basis. So listen, I'm winding down, and I spent a lot of time talking about the bad news because I think near term, there's a lot of potential bad news out there. And the potential bad news out there is just the Fed pushing us into a recession, frothy market valuations, earnings are still too high. I promised you, second half of the year, maybe not the second 6 months, but just later in the year, we expect a much better story. And again, number one is that you have all this pessimism. Pessimism pushes down expectations. Pessimism like, oh, the consumer is going to stop spending as much, higher energy prices, or slow down in bank lending. You have all that pessimism, it pushes down expectations. And this happens going into most recessions. Expectations come down. When you have lowered expectations, companies, the economy can beat those lowered expectations and they become easier to beat, and it helps the economy. If you think about the world of economics 101, if the economy is doing better than expected, companies sell more stuff, they generate more earnings, they create the stock price goes higher. And if expectations, if actual data exceeds expectations, if they become easier to beat, it's a good news for the stock market. This is something that we laid out in our 2023 market outlook, why we expect a better second part of the year. Another reason is that we do think inflation is going to slow. I know I've been bashing the Fed for the last, 30, 35 minutes, but we do believe that inflation will slow and the Fed will be successful in reining in inflation. Goods prices are coming down pretty fast. But more importantly, I do think that the Fed is being helped by disinflation. The Fed is being helped by other things that are benefiting them, these tailwinds that they're helping. So first of all, goods inflation is coming down. And as I mentioned before, inventory to sales levels have dropped dramatically. Basically, people have bought everything they need, and it's easier to get products. Think about how easy it is to get a bike now, or to get a Peloton bike, whatever you need out there, it's easier to get. Second of all, in terms of disinflation, you see you see commodity prices have come down. I know we've seen a little bit of an uptick in gas prices lately, but commodity prices overall have been down. I think from their June high of last year, natural gas, or August high of last year, natural gas is like down 60%. Good news there. The third thing is rent. Rent is coming down. So I know if you look at CPI, the Consumer Price Index, everyone is saying, well, rent is still pretty high. That's true. It is high. But if you look at forward rent, like asking rent of properties being listed, new properties, and we call it asking rent. So we go to a website called apartmentlist.com, we compile all this data, and you basically see that asking rent is rolling over pretty quickly. It's good news. It's going to take a while to come into CPI, but it's going to come into CPI. It's going to come into lowered expectations. So second point is that inflation slows. The Fed does a great job at reining in inflation, but again, they're being helped by disinflation. The third point, and this is where I've alluded to this a few times, but the recession. We do believe that we will have a recession. I can't say 100% guarantee, but there's a high probability that we'll possibly have a recession. Let me put it that way. But this recession, which it's been called the most anticipated recession in the history of our country, we do believe it's going to be very mild. And there's three reasons why. Number one, the labor market is so strong. There's There's 10 million more jobs out there than people looking for jobs. There are so many jobs out there. People can find jobs pretty easily. Unemployment rate's at 3.5%. Yes, unemployment is going to rise. Yes, we're seeing payrolls start to slow down a bit. Even payrolls have come down, but they're still coming in at 200,000. That's a still pretty good number. And jobless claims today came in a little bit higher than expectations. The labor market will be impacted. We know that, but it's coming off a super strong, very, very low base. It's going to be impacted, but it's going to be very minimal. The second reason, the one that people keep talking about, is housing. And we want to stress housing is not like it was in 2008. First of all, we have completely different mortgages. Back in 2008, you had lots of adjustable rate mortgages. You had no income verification loans. Today, about 90% of mortgages are either 15 or 30-year fixed, and they're amortizing. That's great news. Plus, if you look at mortgage debt to total income, it's extremely low. Also, the key point about housing is that if you look at owner's equity within homes, so basically how much do we have built in owner's equity? Right now, it's around 73% on average. It's an average number, but it's about 73%. During the 2008 housing crisis, it was around 41, 42%. And we haven't seen 71, 72, 73% since the early 80s. Why is that important? Because prices are going to come down. Let's face it, home prices will come down a bit. It just makes sense because basically either people can't find homes because of low inventory, or basically because the economy slows down. But because owner's equity is so high, owners are not forced to sell. So again, housing is not like 2008. Strong labor market, housing not like 2008. The third reason, and this is something that's, let me kind of work your way through this. This is such an important concept. We anticipate that this recession will be a rolling recession, a mild recession. And what I mean by rolling is that not a sharp, steep drop, but only certain sectors of the economy get hit, and then they recover and other parts get hit. Something that rolls through the economy ever slowly. So what's in recession today? Housing, manufacturing, autos are in recession. What's not? Consumers are still spending money. I know retail sales slowed a bit last month, but consumers are still spending money. What we're seeing now is that housing is starting to stabilize. You look at the home builders; they're starting to rally right now. You look at multifamily construction; that's at near big, not historic highs, but very strong highs right now. If you look at construction employment, is at near record levels. Basically, housing is starting to stabilize. Manufacturing data is starting to stabilize. I know we got an ugly number from the Philly Fed today, but if you look at the New York Fed, if you look at other data points, manufacturing, it's down, but starting to stabilize. And at the same time, the consumer is starting to get impacted. So long story short, we don't see everything falling dramatically. We see parts of the economy being hit, other parts doing well, and then this starts to stabilize, and this starts to get hit. A mild rolling recession. So again, good news there. So I know I'm going to kind of fly through this pretty quickly. A lot of times you get questions like, how do we stay updated? Please talk to your advisor. Please, constantly work with them, reach out to them. We help provide tools for our advisors, like market outlooks, like the Fed Monitor. These are all client approved. Twitter, you can find us on Twitter. And then our advisors have access to a week ahead video. So videos of me talking about the key points to look at for that week. And one thing, one thing we just introduced 2 weeks ago, we do these fun commentaries. They're more engaging. We talk about investing, but we tie it to a fun topic like donuts and investing, or tie it to not that 70s show, to investing, fun things. And we just came out with a new commentary a couple weeks ago. We talk about opening day baseball. How do you invest like managing a baseball team? You need specialists. You need key advisors. You need people who have certain roles. You need to be invested in different parts of the market. It's almost like a baseball. I'm doing a terrible job at that, but you get my point though, hopefully. So I just want to, I know I kind of went through this quickly. What's your key takeaway? Number one, make sure you're in constant contact with your advisor. Always, they need to understand where you are in terms of your overall goals, your investor objectives. Number two, be diversified. A lot of times at the last bull market in the early 90s, that bull market that everyone was buying technology stocks, it was like large cap growth and technology stocks. Again, be diversified, have exposure to different parts of the market. Don't just invest in one single part of the market. Be diversified. Thank you so much. If you want to follow us on Twitter, my team is Satara IM, or you can follow me at Gene Goldman. And thank you so much.